Afternoon, everyone. This is Curtis Hawks with Insurance Agency Marketing Services. And I want to say, first off, we appreciate everybody taking the time to be on the call with us today. We see a lot of really good opportunity in the life insurance space. And so we want to talk about that a little bit today and how you can capitalize on that. Before we get started, I wanted to take just a couple of minutes and chat a little bit about some of the different ways that IAMS can help partner with you in your business. So first off are our new producer builders. If you're a new advisor to us or haven't worked with us in the past, one of the things that we want to do is make sure that we're doing an effective job of helping you with where you're at and helping you get to where you want to be at whatever level. And so we've put together a variety of different options and things that are available to help you grow your business, whether it's through marketing, additional cash going into your company, software, you name it. And so I would encourage you to reach out if you've got questions on that to us and talk to one of our sales directors. They're more than happy to chat with you about that. Secondly, we've got our IAMS business builders, and this is one of the best ways to get additional capital and increase your marketing budget that you're going to find out there. First is our referred producer program, and this is honestly some of the biggest checks that we send out. But this is a great opportunity if you are working with us and you like what we're doing. Send us some referrals. Not only can you get some cash when the advisor contracts, but then one of the key differences of what we do is you'll continue to get checks on a quarterly basis based off of their production without having to do anything. So it's a great way to add some additional revenue to your bottom line. Secondly is our marketing reimbursement. This is a great way to generate additional marketing dollars and increase your marketing budget, whether it's on the traditional flow premium life insurance side or SPL for that matter, which is what we're going to be talking about today. In addition to that, you can accrue funds on the annuity side as well. So if you've got questions on any of that, feel free to reach out to us, talk to your sales director, but a couple of good ways to increase what it is that you're doing. So today we're going to be talking about single premium life insurance. We've got Gary Voith, who is the VP of Business Operations and Planning over at Baltimore Life, on the call with us today. And right now we've got a really unique environment when it comes to life insurance. And on a couple of different fronts. First off, you've got a significant amount of legislation that has passed over the course of this year. At the top of that list is the SECURE Act, where in effect what that was an increase in tax revenue for the government on qualified accounts by eliminating the stretch IRA. And so the need more than ever for ways to efficiently in a tax advantage format transfer wealth has become critically important. Secondly, you've got the CARES Act that passed earlier this year, and as we all see in the news, there's more than likely a second package that is going to go through before the end of the year. And so you're talking about significant increases in the amount of debt that we're taking on as a country. And we know that the current tax legislation, the Tax Cuts and Jobs Act that we're currently filing on, is set to sunset in 5 years. And so all of that creates a really unique environment in that we know that the government has taken some steps to try and increase the amount of tax revenue that they get from qualified funds. We know that we're taking on significant amounts of debt, which when you look at how the government runs, it's tax revenue and government issued debt, and it's an inverse relationship. So the expectation is over the next few years that we probably are going to see some tax increases, whether that's through an increase in tax rates or whether it's things like we saw in the SECURE Act where they eliminated the stretch IRA provision. Well, we don't quite know what they're going to do. What I think it all supports is the use of tax advantage vehicles like life insurance that give clients the ability to generate tax-free benefits, whether it's via chronic illness, whether it's for purposes of wealth transfer at death, or even in traditional life plans where you can access cash on an income tax-free basis. So today, Gary's going to be on the phone with us, and he's going to chat a little bit about product, sales concepts, as well as some different ways to market these types of products in our current environment. So with that, I will go ahead and hand it over to you, Gary. I appreciate you being on the call with us today.
Thank you very much, Curtis, and good afternoon, everyone. Always a pleasure to be spending some time with our friends from IAMS, who have done a great job through the years being one of our leaders in the area of single premium products. I know you do a fabulous job in the area of annuity products, which means you're working in that senior market space. And that's really what we want to talk about today, is the opportunity that you have to provide your senior clients with a tax-efficient way to pass on assets to the next generation. We're going to be talking about two products in our portfolio today around the context of tax efficiency, and that is our generation legacy and single premium whole life products. Both of these products are really designed with your senior clients in mind, who have what we like to call some leave behind money. Money they don't need to live on, they simply want to leave behind, thus creating a legacy for their family, but again, doing it in a tax efficient way. No matter whether you've got funds coming from after-tax cash vehicles, CDs, money markets, mutual funds, 1099 or deferred, I'm losing it here for a second, but a rollover of an existing product into the single premium product, or a qualified fund, an annuity or a qualified plan. We've got products that can satisfy and address those needs. If we take a look at the landscape of asset transfer, it's actually absolutely huge. Trillions of dollars of wealth are being transferred, and that's going to continue to happen over the next 50 years. 75% of our parents really don't believe they do believe it's important to leave an inheritance, but only 20% agree strongly that their children will be prepared to handle that wealth they're receiving. We know that a high majority of the people believe their families would benefit from a formal plan. Only 10% of them actually have one in place. And and I know, how often do you get with seniors where you see they've set up multiple CDs in an account that they have, and you say, what's the purpose of the money? Well, I'm setting aside money for my favorite charities, my grandchildren, my children, for various reasons. And in your heart there's a better way of doing exactly what they're ultimately trying to do with these types of products. So the first product we're going to talk about is Generation Legacy. And this product really is designed to take single premium dollars from annuities and qualified funds that aren't needed for daily living, thus creating an estate for heirs and favorite charities, increasing the estate value through this process that they're able to pass along. And the issue age for the product is 60 through age 80. Now, this product very uniquely will allow you to write a single application with us. And as a result of that single app, we'll issue two products, a single premium immediate annuity, along with a limited premium payment whole life product. Both products, once issued, will automatically be administered by Baltimore Life to provide all the benefits that I'm going to be showing and talking to you about here today. We have simplified underwriting on this product through 4 tables, and the product also automatically includes, in all states where it's approved, our accelerated death benefit rider, which truly can provide living benefits to a client at a time when it's needed most. Now, along the way over the past 2 years, we've really found some market opportunity out there for people that our agents are running into, that are couples that have one person who was healthy and insurable, and then another person in that couple who was not insurable but had significant assets they were also trying to move. So in those situations, we offer the kind of the wrinkle of Generation Legacy, the spouse option. And so you have a healthy spouse who would be the insured party for the life product. You have the unhealthy spouse that would be the funding mechanism for the life insurance, right? So you have 2 people involved. Now, the SPIA payouts, we continue from the unhealthy spouse to fund that life insurance we'll talk about, regardless of whether or not the annuitant dies or not. So if they're unhealthy and you have 10 years of payments to pay off the life product, that annuity will continue to pay out regardless of the annuitant being alive or not. We want that life insurance to be paid up, so ultimately the plan can be self-completing. The annuitant waives the right for the beneficiary to commute any future values of those payouts in that situation. But the good news is there's no maximum age limit for the annuitant when the annuitant is different from the insured. So you could have a very senior unhealthy spouse and a younger healthy spouse. So the healthy spouse becomes the life insured, and the older spouse becomes the annuitant. That can work in either situation. So these are opportunities you run across, and when you do, we have a situation to use generational legacy just for that. And when you take a look at the funding opportunities out there, there's approximately $7.3 billion of in-force deferred annuities. They're about 65% are in tax qualified employer-based plans, and 35% of those non-qualified annuities that you sell. A significant share of this money, as you know, is just going to be transferred to the next generation. Many people, of course, are setting up these annuities for growth and deferral of tax on that growth. But eventually taxation does occur for minimum distributions, which is now at age 72 and a half, correct? Not 70 and a half. And that taxation is, of course, going to happen once the annuitant dies. So if the insured dies, or has an annuity, I should say, and dies, they're just going to pass the tax along to their living heirs that are probably in a higher tax bracket than they were. So we know annuities are fabulous products, but the question is, are they really the best products to have if you're just going to die with them, or is there a better path to take? Well, we feel generational legacy, in fact, offers that. Let's look at it conceptually. Think of generational legacy as a gift, and a gift your client is trying to pass along to the next generation. Inside that gift box, you're going to help facilitate with your clients the transferring of annuities or qualified funds into the gift box. By writing a single application again, we will issue two products: a single premium immediate annuity, which is going to receive the transfer of funds that you're bringing over to us, and that SPIA will go to pay for a limited premium payment whole life product. Now, over a period of either 7 or 10 years, that SPIA will automatically make annual premium payments to the life product until the life product becomes paid up. So what is the payment options here? So if you have a client who's 60 to 74, we'll do a 10-year payout on the SPIA to pay up the life product. And if your client's 75 to 80, we'll set up a SPIA over 7 years to pay up a 7-year limited premium payment whole life product. But here's where the benefits really get rich. What if your client were to die during the period of time while that SPIA is funding the life insurance? Well, we know the life insurance will always there to be paid an income tax-free death benefit, right? That's great. And the death benefit's going to be greater than the single premium paid. But what about the remaining payments from the SPIA? Well, if you're 2 years into a 10-year payment stream and the client dies, the remaining payments from that SPIA would automatically go, in addition to the life insurance income tax-free benefit, also be paid out to the named beneficiary. We'll talk a little bit about payment options to the beneficiary on the SPIA in just a moment, but they're getting both, and that's the beauty of how that product works. At the end of the 7 or 10-year period, the life insurance becomes fully paid up. It continues to provide the income tax-free death benefits, and yes, continues to provide tax-deferred cash value growth and the accelerated death benefit rider that I'll talk about in just a moment. So just to recap, the issue age is 60 to 80. We base our pricing on current age or age at last birthday. Now, the reason that's important, because we're going to be transferring funds from other products and institutions, and that transfer process might take 20 to 45 days. We're going to issue the policy based on the age your client is the day we receive the funds. Now, the minimum premium to get started is only $5,000. How many annuity clients do you have out there that have multiple annuities and over time just keep renewing those annuity periods for another guaranteed run at it? But their only goal is really to pass the money along to the next generation. They're never really going to use it for income. Great prospects for this product. The maximum face amount that we'll issue based on the single premium paid is $450,000. Now, the underwriting class, we have one, it's standard, and the standard underwriting class is a blended rate for any risk standard through table 4. We have 2 premium classes, non-tobacco and tobacco. Cash values, they accumulate in this life product on a non-participating basis. Partial surrenders, you can take partial surrenders from the life product, but they're permitted after the life policy becomes paid up, 7 or 10 years. Loans, they're available at any time from the life product at a maximum rate of 8%. So now let's talk about that accelerated death benefit rider, which truly can provide living benefits to your client at a time when it's needed most. There are 3 health event triggers that will allow your client to accelerate the benefit. They are terminal illness, qualified nursing home confinement, and in situations of extended care, home health care, and adult daycare. This does increase the liquidity of the life product, and upon the decision to accelerate, which can happen anytime after issue, a lien for the amount of money taken will accrue at an annual rate of 8% prior to death. I'll show you an example of that calculation in just a moment. The maximum that you can accelerate is $250,000. The minimum is $5,000. But the good news is this benefit is paid out once. It's paid out in a lump sum, and there are no restrictions to taking the funds. It can be used for whatever reason the client is needing those funds. So now let's look at the definitions of those payouts and take a look at actually how each of them break down. The first one is terminal illness, and simply put, the client needs to be diagnosed as terminally ill with a life expectancy of 12 months or less to live. In this case, they can accelerate up to a maximum of 75% of the face amount. For qualified nursing and extended care, the maximum accelerated rate is 50%. For the nursing home confinement, the client needs to be diagnosed as chronically ill, confined to a nursing home continuously for 90 days, but with the expectation of a permanent confinement. For extended care, home health care, and adult daycare, that client needs to be chronically ill and has been so for 90 days, but now is requiring care provided by a licensed home health care agency or a licensed or state certified adult daycare center. In both cases, again, maximum accelerated rate is 50%. Now, there are states that have reduced amounts that you could accelerate at above these amounts that I've shown you here. It's about 5 or 6 states that have that. Those are outlined on our state approval charts. Pennsylvania and Indiana are just an example. But I will tell you that the rider is really designed to be able to pay cash out now as a living benefit, but also in most every case have remaining life insurance death benefit. So what's the definition of chronic illness? If the client satisfies either of these definitions, we consider them to be chronically ill. The first is they can't perform 2 out of 6 activities of daily living that you see on the screen. But maybe they're okay on their ADLs, but they could be suffering from a severe organic mental illness, such as Alzheimer's or dementia. In either case, we consider them to be chronically ill. So let's look at an example of how these payouts could occur. This is assuming that the client has a face amount of $100,000. They're terminal, and they're going to take the maximum of 75% of the face, which is $75,000, as a living benefit. Now, we do charge a one-time service fee for the transaction to make that payout. So the lien is established at $75,100. So if the client were to die immediately after getting that money in cash as a living benefit, no time for interest to accrue on the lien, the remaining death benefit would be calculated by taking the face amount of $100,000 less than $75,100, giving you the remaining life insurance benefit of $24,900. But here's the more likely example. Same thing, 100 grand in face, 75% being taken for 75 grand. So now the remaining death benefit after a year of having that cash in hand before they died, we would take the face amount of $100,000 less the original lien of $75,100 plus 1 year's worth of interest on the lien, giving you a remaining life insurance benefit of $18,892. Now, you might ask, could these riders technically terminate from the life insurance policy? Well, if you stop the life insurance policy, it would end the rider. And you might think to yourself, why would the life insurance policy end if the SPIA is automatically paying for it and funding it? Well, technically these, even though they work harmoniously together, Baltimore Life administers these together, the insured could come back 2 years after we start this and say, I want to decouple it and I need as much money back as possible. Well, they could cash out the life policy that would have very little cash value after 2 years, and then take the remaining payments from the SPIA as an annuity. If they did that, the riders, of course, would end. If the insured dies, we pay a death benefit out instead. And if you accelerate, let's say at 50% under the nursing home provision, you can't accelerate a second time. You can only accelerate once. In the very, very odd situation where the interest on that lien outruns the remaining death benefit, technically the riders would terminate, but the owner could repay all or part of that lien at any time to keep this qualified as a life contract. In that terminal illness example I showed you, the insured in a terminal condition would have to live 4+ years for the interest to outrun the remaining death benefit. Extremely unlikely that's going to happen, and that's why the products are priced that way. Even though you accelerate, there's still some cash value that accumulates in the life product, and if you have a lien against the policy because of the rider, you cannot also have an active loan going on. It has to be one or the other. Of course, in all situations, you want to make sure your client consults with their tax advisor when taking out a benefit on these riders. Technically, in most situations, there's no tax liability, but hey, that's up to the tax experts to tell you that. So if you look at quick example, here's a female 70 non-tobacco user who puts 50 grand in. They get a life insurance benefit at 70 of $78,055. So they've immediately increased their estate at issue by over $28,000. And if they die, during the first 10 years, the remaining payments from the SPIA would also be paid to their named beneficiary. But look at those payouts on the accelerated death benefit rider. As you know, most seniors cannot afford long-term care insurance. It's difficult to afford, not just the initial, but the ongoing increases in premium they see. Isn't it nice to know that they can actually get cash in hand for whatever reason under these types of medical conditions? So what's another tax benefit of this product? We feel it's the transfer of funds. Let's say you have money all coming from an IRA. Well, that money's never been taxed before. You could have money coming from an annuity where there's a basis and a gain. Eventually, Uncle Sam's going to get paid on the tax on the portion of the money that hasn't seen tax before. But when you're rolling the money from, let's say, an IRA into this product, because it's going to be used as a funding vehicle for life insurance from that SPIA, we're able to help the client spread the tax out on that gain over that 7 or 10-year period while the SPIA is funding the life insurance. So yes, the annuitant will get a 1099 each year during that period while the annuity is paying the life insurance. But again, they're able to spread the tax out. The annuity payment we make to the life insurance does require satisfy the RMD rules at 72, so you don't have to worry about that any longer. And I need to change that on my slide. If death benefits occur, or if death occurs from that SPIA payout, don't forget the beneficiary will receive the remaining payments from the SPIA. Now, the method that we pay out death benefits from the SPIA are in over a 10-year payout period. So if it's a 10-year pay or a 7-year pay, the remaining payments each year are paid to the beneficiary. But the beneficiary could elect a commuted lump sum. So in either case, they will get a 1099 based on the distribution. One quick thing about the application. On the application, just know that we cannot have the client elect for us to withhold tax on the money that they're rolling over to us. The math just will not work on the product. So please make sure you check the box on the app that says that you do not want tax withheld from the annuity that you're rolling over. Otherwise, we have to send everything back to you. So here's some quick payout examples just to show you how powerful this product can be. 65-year-old non-tobacco user has 50 grand. Because they're 65, we'll do a 10-year payout on the SPIA to pay up that life product. For the male, the face amount would be $76,979, and for the female, the face amount is $86,605. So what did you just do for this lady at 65? You've increased her estate at issue on the life product by $36,605. And yes, if she dies during the first 10 years, the remaining payments from the SPIA would also be paid. Now, she may say to you, Curtis, well, what if I just kept the money in the annuity and, I was making 3% interest and I'm in a 24% tax bracket? It would take her over 18 years just to accumulate the $36,000, almost $37,000 we increased her estate by. So it really is beneficial for her to use a vehicle like this if her primary goal is to move the money to the next generation. Here's the 75-year-old, a little older, shorter life expectancy, but the numbers still look good, don't they? Because this person's 75, we're going to do a 7-year payout on that SPIA to pay up the life product. But for the male, you're seeing a death benefit of $61,209, and for the female, a face amount of almost $67,000. So you've increased this lady's estate by what? Almost $27,000, and for the gentleman, you've increased his estate just over $11,000, knowing that if they die in the first 7 years, the remaining payments from the SPIA would also be paid. I'll tell you this, I'm a licensed agent myself, and I know that, you know, when you explain the concept of how this works and the need is there and people buy, and even when they don't buy, they're going to find that you're going to have a great referral opportunity from that person. So please make sure you ask for referrals early and often. Here's a quick ledger example of how the Generation Legacy product works. Here's the female 70 non-tobacco who puts in 50 grand with a cost basis, let's say from an annuity of 40 grand. You can see the single premium going in, 50 grand. The SPIA payout to pay the life products, $5,250. The amount excluded from tax is just over $4,000 based on that $40,000 basis. And you know, you have to anticipate interest on that money over this 10-year period. The estimated taxable income is $1,249.50. That's what they'll get the 1099 on. So don't have that be a surprise. Make sure they know it. And of course, the ledger goes on to show the death benefit of over $78,000 and the commuted lump sum death benefit of the SPIA if death were to occur early. This ledger is a small snapshot of what is included in a non-illustrated proposal that you can get on our system, as well as use our, you know, our software that we have that will allow you to do this right on your smartphone. Okay, so we'll talk more about that in a moment. Applications, just simply go to our agent website inside of the product toolkit, and you'll be able to get to the printable application and forms package and give you all the forms that you need to do business with us. Your friends at IAMS certainly will help you as you get into your first application with us to make sure you have everything you need. We also have lots of good sales marketing tools and sales and marketing tools on our agent site. One of the things I referred to earlier is our tool called Mobile Link. Mobile Link will allow you on your smartphone or smart tablet to do not only a review of the product with all of its features and benefits to remind you of those things, all the underwriting guidelines, and then it has an interactive rate and value calculator that will allow you to calculate everything you need because, again, this is a non-illustrated product. No signed illustration is needed. So that ledger I just showed you for Generation Legacy, you can do that on your phone. And Single Premium Whole Life has a similar tool. Plenty of other good tools, client brochures, customizable marketing flyers, lots of good pieces out there for your use. Let's talk now about Single Premium Whole Life. That's our second product. It's the sister product. And it has many similarities in terms of its goal. It's designed to allow families to leave an estate for their heirs greater than the premium they paid in. But there's some significant differences as well for this product. And the first one is the biggest, and it has to do with the source of funds they're going to fund this product. We know with Generation Legacy, it should be coming from annuities and qualified plan funds. But for Single Premium Whole Life, it should be coming from after-tax cash vehicles, CDs, money markets, mutual funds, and where appropriate, 1035 life product exchanges. So, and where it's appropriate for those. The issue age for the product is 50 to 85, a little broader issue age because of the fact you're working with after-tax cash funds. This product also has two tiers of underwriting. We have a standard and a special tier that goes through 8 tables. We'll talk about that. It also automatically issues in all states where it's approved, and that's the high majority of states, our accelerated death benefit rider. The rider on this product works a little bit differently. I'll show you how that works. Again, 50 to 85 is the issue age. It's based on current age or age at last birthday. We have the standard underwriting class, which is blended rates, standard through table 4, and our special underwriting class for a blended rate, tables 5 through table 8 types of risk. So a client with a few more health conditions would qualify for this after-tax cash product. Premium classes, again, non-tobacco and tobacco, and the minimum premium, again, to get started is only $5,000. How many clients do you have out there that have money in CDs and money markets, and they've set up multiple CDs, let's say for their kids or their grandkids? And as you know, our seniors tend to compartmentalize their funds, right? So here's, 5,000 for this grandchild and 10 for that, and this so much for my kids. They all have different purposes and meanings, but they're compartmentalizing their funds. Great opportunity to show them how you can significantly increase their estate value by moving it into single premium whole life. What about those clients who you're trying to sell life insurance to, and they say to you, well, I really don't need life insurance, Curtis, because I have a burial account set up. Well, that can mean one of a couple of things. They either have a pre-arrangement through their local funeral home, or they have a $15,000 CD set up at their local bank. And, if you're talking to a lady 70 years old, you might say, Mrs. Jones, you're 70. You're going to live many more years, and I'm sure you'll agree costs are going to go up. What if I was able to show you a way to provide your family with a nearly $25,000 income tax-free death benefit? And oh, by the way, if you became terminal in a nursing home or an extended care situation, you can actually get at some of that money and still have a certain amount of paid up benefit for your family as well. Is that something that would be of interest to you? And that's what we call our burial account concept. I can't tell you how many agents get started selling these products using that simple tool. The biggest thing they learn, though, for agents who are new in selling this is product and this market's all about a good, effective fact find. Not only finding the money, but finding the reason they need those funds. Are they using it for income? Are they using it to pass along to the next generation or to a charity or whatever? So it's important to do the good, effective fact find to be effective in this market. The average premium we see on the single premium whole life product is about $30,000 to $35,000. The average premium we see on Generation Legacy is about $50,000 to $55,000. Now, the maximum face amount for single premium whole life is expressed in terms of the maximum net amount at risk. And that's just a breakdown chart showing you that based on age and underwriting class, what the maximum net amount at risk is. Net amount at risk is simply the difference between the face amount that we issue and the single premium paid. That gap is the net amount risk. Cash values, they accumulate, of course, on a non-participating basis. But here's another big difference. Partial surrenders. You can actually take partial surrenders on this product during the first 6 years within limits. And, if people need to tap into the funds, they can, at certain limits, going from 10% up to 100% over those 6-year periods. All that information is out there in your agent guide, but it does provide the clients flexibility in times when they might need a little cash for whatever reason they didn't expect to need cash, but they need it, and they can dip into this product that does provide them with a legacy type of benefit. Loans, they're still available on this product as well. Now, the accelerated death benefit rider has the same 3 health event triggers we talked about with Generation Legacy and that you see on the screen. It also provides the benefit payout once in a lump sum, and these are unrestricted funds. The money can be used for whatever reason the client deems necessary. But here's a big advantage this product rider offers that Generation Legacy doesn't have. It's just the nature of when the products were filed and how they work. You can do partial accelerations on this product, preserving a certain portion of the death benefit, kind of like a paid up policy, so to speak, but still do an acceleration of the benefit as well. The Generation Legacy product works on a LIEN concept. That's how many of the riders out there work today. That's a newer product, and it was filed that way because at the time that was the way products needed to be filed for this rider. But for this one, you can do a partial acceleration. So let's look at some examples around the triggers. Terminal illness, still 12 months or less to live. But in this case, the client could say, you know what? I want to do a full acceleration. That means they can take up to 95% of the face amount less a $250 admin charge. People ask me, well, what happened to the extra 5%? Why can't I take 100%? Well, if you're expecting to die within 12 months, we're essentially advancing you a death benefit, we'll say 12 months in advance. And in this case, there's a cost for money, and that cost is 5%. That's kind of the holdback on that. But I will tell you that the client may say, you know, I have 100,000 in face amount. I want to keep 25,000 as a paid up policy, and I want to accelerate the other 75,000 in face at that 95% less the 250 admin charge. That's a partial acceleration in how it would work. Qualified nursing, same definition of qualified we talked about before, but here, because the client's going to live a little longer, the maximum accelerated rate is 90% less the admin charge. And for extended home health, extended care, home health care, and adult daycare, they're going to live longer yet. The maximum rate of acceleration is 80% less the admin charge. Chronic illness, same definitions to qualify, 2 out of 6 activities of daily living, or a client suffering from a severe organic mental illness. Either one gets you qualified as chronic illness. So now let's look at premiums to death benefits. And I want you to think about that client out there who has money in the CDs and the money market accounts, and they're setting them up for the kids and the grandkids, or they have 1035 money that you can roll because they might have a failing UL out there. And here's what you can do. You've got a 65-year-old with 50 grand. For the male, the face amount under the standard underwriting class would be just over $80,000. And for the female in that same underwriting class, the face amount would be just under $91,000. Now, if they had some health issues and fell in the special underwriting class, Table 5 through Table 8 types of risk, the death benefit would be roughly $5,000 to $6,000 less. And that's really true in all ages and genders, okay? So the rule of thumb is when you move to special underwriting classes, it's about a $5,000 to $6,000 reduction. Not bad to have that second tier of underwriting. So what did you do for this female 65? You've increased her estate by almost $41,000 at issue, knowing that if she left the money in the CD and made 3% interest, good luck on that, 24% tax bracket, it would take her almost 27 years just to accumulate that bump, so to speak. You gave her an estate value of over $41,000, keeping in mind that the life insurance benefit of nearly $91,000 is there to be paid income tax free. Here's the 70-year-old. The numbers still look good, don't they? For the standard underwriting class, just over $72,000 for the male, almost $81,000 for the female. And again, the special underwriting class gives you about a $5,000 to $6,000 reduction. Forms, go to the application and forms package inside of our product toolkits. Pick up the phone and call your IAMS partners, and we'll take care of you and getting the forms that you need. All the sales and marketing tools are also out there for this product, just like they are for Generation Legacy. Now, getting the products that you need, a competitive product, which we have, well-compensated product, which you can talk to your friends at IAMS on that, but I think you'll be happy with that. That's great. But we know how hard it is to get a lead, get in the door, and get to the point where you can make a sale. Isn't it nice that at the point of sale, you can actually know whether or not the client is going to qualify from an underwriting perspective? That's where our point of sale underwriting process comes into play. So once you've completed that entire application and pre-qualified your applicant, call the call center, and we're going to do about a 12-minute interview with your client to complete the underwriting we need and give you a decision in most all situations. We're going to basically ask them the same health questions that are on the app that you completed on a paper app that you're submitting to us, but we're going to get their permission right there to get the MIB and the prescription drug database search done and be able to determine, is there any discrepancies in what we see out there and what's on the paper app? If so, let's get them, worked out, and let's get a decision made. Let's do live underwriting there on the phone. After the client has completed the interview with us, any underwriting decision is going to be communicated to you, not your client. A lot of times these interviews are done after the sale's made, a couple of days after, and you're not there. You can't be on the call that's made. Any underwriting decision is going to be given to you, the agent, not your client. So we will call you in all cases with the underwriting decision so you can give it to the client. We'll also give you a confirmation number that we ask you to put on the first page of the app. Once the appointment is done, make sure you come back to your office and get us all the forms that were completed, no matter what the underwriting decision might have been. So the call center phone number and hours, 888-368-9678 will get you there. The hours are 9 a.m. to 10:30 p.m. Monday through Thursday and 9 a.m. to 6 p.m. on Fridays. These are Eastern times. We do have and support English and Spanish languages. Other languages are available upon request. If you have a hearing impaired client, we have TTY services in both English and Spanish. Just know, though, that the interview must be completed within 5 days of completing the app. So you might say to yourself, well, what do I do if I'm on the West Coast or I'm after hours and I complete the interview? What do I do in those situations? Well, you don't have to be present for the interview, but what we'd recommend, if you finish the app on a Saturday and the call center isn't open, still pick up the phone, call our call center, leave your name and number, your client's name and number, and a date and time you want us to call them. We will call them, get the interview done, and call you back again with the underwriting decision. If it's during call center hours, it all gets done at the same time. So what about pre-qualifying the app? Well, we do have an app for each product. And because with Generation Legacy, we have one tier of underwriting, that's the standard tier, standard through table 4 types of risk. Think of the Part A medical questions. We only have one part, Part A. Think of those as knockouts. If you get all no, you got good height and weight, MIB, and drug history, you're going to get issued. For single premium whole life, because we have 2 tiers of underwriting, standard and special, we have a Part A and a Part B set of questions. Think of the Part A questions, though, as knockouts. So if you get all no on Part A and B, coupled with good height and weight, MIB, and drug history, we're going to give you the standard underwriting class. If you get all no in Part A, but one yes in Part B, with everything else still looking good, we're going to give you the special underwriting class. That's a quick way to remember it. So with that, I'm going to transfer over here real quick to some final screens related to marketing support for you. If I had that one right, I didn't. There it is. So I'll bring that over here. And I've talked a little bit about the agent site, right? So out on our agent site, this is kind of a screenshot of part of the site. We have these product toolkits that you see up at the top with the colored boxes. There's a product toolkit out there for every product you're contracted for with Baltimore Life. We have agent personalized dashboards with your production and policy information and compensation history. But out in the toolkits, this is where you're going to find everything you need to sell and market our products. Everything from your forms you're going to need to the marketing materials, agent reference materials, everything you need is out there. One of the things that I've talked about is Mobile Link. And you want to jot this down if you don't use Mobile Link today. It's simply mobile.baltlife.com. And when you go to mobile.baltlife.com, save that address as a link on your phone. It'll put a nice little shortcut on your phone or smart tablet, and you're then going to be able to launch it just like any other app that you have. But once you're on Mobile Link, you essentially have a agent, marketing piece, guide, and rate calculator tool right on your phone. It provides you the product information, the underwriting guidelines, and then an interactive rate and value calculator, giving you that spreadsheet that I showed you for Generation Legacy, and a similar nice table to work with for single premium whole life. Again, these are non-illustrated products. We have point of sale presentation material. I'm just going to flip through these screens. It allows you to tell the story of single premium products that you're working with. Get in dialogue with key questions. Go over the features and benefits. Show concepts of how 2 products can work together as one. Show examples related to premiums to death benefits and how that will have a very positive impact on increasing your estate value. It goes to the accelerated death benefit rider with examples. So all that can be shown with our generation legacy product, as well as single premium whole life product as a point of sale presentation. I'm skipping here if you can. Then we have the asset transfer analysis form. Hopefully, and I'm sure all of you have good fact finding tools that you use. But if you need another fact finder tool in this market, we have this asset transfer analysis tool. It allows you to ask those key dialoguing questions. It allows you to record the client's current assets in after tax as well as qualified funds, and shows you that if you transfer a portion of those funds not needed for daily living into one of the two of our products, the impact that'll make on their estate value. It also allows you to record the client's current monthly income. You want to make sure they obviously not only have enough monthly income now, but going forward before you start touching those funds. Good. Okay, there we go. Hopefully you can hear me now. I didn't mute myself too long. So let's talk a little bit about some sales ideas. There's a document out there for your use called Single Premium Sales Ideas. It's a great idea, you know, for a title, but that's what we have. It's out on both product toolkits. And there's a bunch of other great sales ideas for your use. Each of these I have bulleted here have a full description of the sales idea. So leave behind money, people get that concept, right? Annuities, money that's not needed for income, perfect money targeted for the generation legacy product. We have the generation legacy spouse option, healthy spouse, unhealthy spouse, and the unhealthy spouse funds the product. What about 1035ing older paid up life policies where you can increase the death benefit based on the cash values that accumulated in those products? Great tool to do a 1035 exchange into our single premium life product. ULs, we have some of those dying ULs out there even still where the cash values are continuing to go south. If you have at least $5,000, you can 1035, you can put those over into single premium whole life as a 1035 exchange. We talked about the burial account concept. There's a number of other great ideas out there that once you start reading these in detail that we have written out for you, you'll start, you know, just take a piece of paper alongside of you and start writing down people that you can immediately go out and see. You'll make some money just from that exercise. At least you'll tee up the money-making opportunity. We have these great marketing flyers for your use. Goes through the concept of asset transfer in different scenarios, features and benefits of a solution, and then you can fill in your personal contact information. Great leave behind pieces, great mailer pieces, great event marketing pieces, all out there for your use. This is a tool we have that you can download, and it's an Excel file tool that will allow you to do a side-by-side comparison from a CD as compared to single premium whole life. Just plug it in with the appropriate numbers and it does a nice side-by-side so a client can very clearly see that, oh, I was going to put 25 grand in for my grandkids into the bank, making next to nothing in interest, and I'm getting a 1099 each year. How would that compare if I put it into single premium whole life? And you can very visibly show them the differences. We have other, you know, great tools out there. We have white papers and other articles to help support you. And all that can be found out on our agent website inside of these product toolkits. So with that, Curtis, that is the presentation I had today. I just want to thank, on behalf of Baltimore Life, all of you for not only participating today, but being great, you know, leading supporters and producers for us through the years for single premium products. You've been one of our leaders. We appreciate it greatly because we know you have choices out there. Thanks so much.
Well, and Gary, we appreciate you being on the call today. And hopefully many of you see the same thing I do, which is that there's a significant amount of opportunity, and single premium life insurance is a great way to generate significant leverage for your clients. I also wanted to add on as well, I know we've been doing some emails on our Life Insurance Awareness Month package, but in addition to the marketing and the sales ideas that Gary just mentioned, that Life Insurance Awareness Month sales kit is a great way to prospect and market life insurance, both traditional life as well as SPL. So if you haven't received it yet, certainly reach out to your sales director over here. And if you got questions on this presentation, reach out to Sandy Albers here in our SPWL department, or any of the team members on the life insurance team. But we appreciate you taking the time with us today. I hope you have a good rest of the week and look forward to chatting with you.